Why you should do a Roth. That's what we're going to talk about here today at the Heritage Wealth Planning YouTube channel. I'll do this in a couple videos because I think it's actually critically important you understand what is going into a Roth as opposed to deferring your money into your employer-sponsored plan, be it your thrift savings plan, your 401k, your 403b, and I guess you could say a 457 as well. A little bit different there. But anyway, what we're going to talk about here is the Roth component of either a Roth IRA where you have contributions, of which 5,500 is a max if you're under the age of 50, 6,500 is a max if you're over the age of 50, and then your Roth 401k, Roth TSP, Roth 403b. So we're going to talk about that here today. So if you like what you see here at Heritage Wealth Planning, subscribe, my friends, subscribe. So I get this probably an email a day on this, like, Josh, the way I calculated is I'm not going to be any better off by doing a Roth relative to my taxes now versus the future. I had a guy, nice guy, seemed like a friendly enough chap, but he said he was going to use a 33% tax bracket for money going in, so he's deferring 33% and instead would pay 22% on the money coming out. And I said, well, in that case, yeah, you should absolutely do a traditional as opposed to Roth. I mean, if you're saving 33% in tax deferrals today and you're going to have 22% coming out, it's going to be hard to make the argument that a Roth is better. However, I would still make that argument, and we'll show you with that here in this series of videos we'll do here today to talk about the benefits of a Roth, because everybody seems to be missing a couple key components on the Roth. It's not just taxes now versus taxes later. Yes, that is an integral part of the solution of the idea. If I'm in a 33% tax bracket and avoid paying 33%, and that way I can only pay 12% or 22% in the future, inherently a Roth looks a little bit sketchy for that one comparison. If I'm in a 22% tax bracket now and I'm going to be in a 22% tax bracket later, it's not even Steven. The scales are tilted in favor of the Roth significantly even there. If I'm in a 12% tax bracket now and I'll be in a higher tax bracket in the future, then it's not debatable. Roth is the way to go. So even of those three scenarios, two of the three absolutely outweigh the Roth, which we'll show you here today. And I'd even argue the third one will as well. Again, the third one is I'm a higher tax bracket today than I will be in the future. So let's dive right into this. So I got a couple here. We're going to say husband and wife. All right, and so they're husband and wife, they're married. Now, will this same apply to single people? Probably not as much. We'll talk about that in a different episode here, but for single people, we're just talking about married people. But if you're single and you're thinking about getting married, that might be something to consider. But for right now, we're just talking about married couples. So we got husband and wife. Both are 50 years old, 50-50, all right? They both have 401ks of 150,000 in it, all right? So they each have 150,000 in their 401k. I just made these numbers up. I mean, you can do whatever you want, but just follow me, for example. They both make, between them, they make $100,000 of income, all right? So $100,000 of income, of which 50 is for the husband and 50 is for the wife. So we're married filing jointly. I'm not going to have any deductions, not going to have any homeowners, housing, mortgage interest, not going to have anything like that. Just straight numbers so you can see where this is going. All right, so again, husband and wife both have 150,000 in their 401k. Both are getting 50,000 a year as income. So even Steven across the board. Their company matches 8% of their contributions. 8% of their contribution the company matches. So husband says, I'm going to put $10,000 of my defer. I'm going to defer $10,000 a year into my 401k. And wife does the exact same thing. She's deferring $10,000 a year into her 401k as well. And they're getting a $4,000 a year match. And she's getting a $4,000 a year match too. So the exact same scenario on both sides. Both 50, both 150,000 in the 401k. Both putting $10,000 a year as deferrals into their 401k. Both getting a $4,000 match or 8%. That's how it works. Now, what happens is, because they're putting that $10,000 each into their 401k, their income, their gross income is $100,000, all right? But they have $20,000 they're just writing off the top because that is a salary deferral. You're deducting it. You're saying, I'm not getting a salary, so it's not countable as taxable income in the year in which you defer it to your 401k. So their AGI, their AGI, after you take those $20,000 of, it's not even a deduction, it's just not even counted in the tax form to begin with. But anyway, that will be $80,000, all right? Now they have $24,000 of standard deductions, $12,000 for him, $12,000 for her because they're under the age of 65. which means their taxable income is $56,000. All right, so we have taxable income of $56,000. So I go to my trusty calculator and I say basically, and look, this is not going to be to the exact dollar amount, and just you don't need to be to the exact dollar amount. But we're going to say the first $19,000 is taxed at 10%. Which even me in my head can say that's $1,900 of taxes. Now, 56,000 minus 19 is what, $37,000. Which is taxed at 12%, and that is, and I already did this, so if you think I'm so smart, keep thinking that, but I already calculated that with my trusty calculator. It's $4,440, so that's $4,440 in tax, which means their total tax is going to be $6,346. All right, so you with me so far? So $6,346 is their tax in this scenario. So don't pay much mind to these sidebars yet. Just remember, $6,346. Now, let's do this. Let's say they don't contribute to their let's say they contribute the $10,000 to their Roth as opposed to their deductible or the deferred, I should say. So now, they don't have that $20,000. They have $20,000 more of taxable income. So now we take the $24,000 of standard deductions, and their taxable income now is $76,000. Minus $19,000 for the $10,000 percent or 10% tax bracket. Now, I do need to break out my trusty calculator. What's that going to be? 57,000, I think. 57,000. Let's see. Yeah, 57,000. And that's at 10%. At 12%. So that's 1,900 here. And 57,000 times 12% is 6,840. So you add these two together, and I don't know, so I got to get my calculator. Plus 1,900, 8,740. So they pay $2,500 more in taxes because they have $20,000 more of income, if that makes sense. And there you go. There's a 12% bracket. All right, so $2,500 more in taxes. Let me write that down. I got to write it on my note because we're going to come back to this. 8740 tax with Roth. All right, so let's keep going. So let's spray this off. So far, so good. You with me? You with me so far? So again, we have, in fact, I'll probably stop this one right here and go with another one after just a second. So the situation, just to revisit this, is they have the choice. Should they defer the $20,000 to a 401k deferred and they'll save $2,500 in income tax, or should they defer, or should they just pay the Roth and pay the tax now? It's going to cost them $2,500 more. So we'll come back to another one, part two of this in just a second. So as always, if you like what you see, subscribe, comments, questions, thoughts, the whole thing. Go to heritagewealthplanning.com. I put all kinds of stuff on the blog there. In fact, this whole morning I've been adding stuff. A lot of videos, a lot of the podcasts, whatnot. But anyway, don't forget to subscribe, and then comments are always welcome and thumbs up too. All right, so stay tuned. We'll see you in the next one. Thanks now.